everyone. Good evening, good morning, good afternoon, wherever you're listening from. We're just going to give everyone just a few more minutes to join, and then we'll kick things off, writing materials, and settling. Hello, everyone, and warm welcome to today's session. My name is Onye Obazi, and I'll be your moderator today for this valuable deep dive into research report writing. So, before we dive in, let me quickly introduce who we are for those joining us for the first time. Analytic Sages is a data upscaling organization and the flagship subsidiary of Sages Lab. We're on a mission to democratize data skills and place talents with proof. We train the next generation of data professionals through hands on, project based learning in SQL for blockchain analysis, Python for data analytics, and Web3 data careers. Today's session is part of our commitment to bringing you practical, actionable insights, not just theory. So before I move ahead, if you can hear me, you can just do well to indicate in the comment section by telling us where you're joining in from. That would be much appreciated. So, today's topic is one that doesn't get enough attention, yet is absolutely critical, right? Basically, how to write investor ready research reports using data and on chain insights. Here's the truth: you can have like the best data, the sharpest insights, and the most accurate predictions in the world. But if you cannot communicate them effectively, nobody's going to listen to you, right? So for Onchain analysts, researchers, and anyone building in this space, the ability to structure findings, frame them for like the right audience particularly, so you like really need to know your audience and present them clearly is what separates work that gets noticed from work that gets ignored. So today we are going to fix that, right? And to deliver this, we have someone with deep experience in on-chain analysis, report writing, and data communication. Please welcome Mr. Mouse, Mr. Johans, sorry. So Mr. Johans, aka Mouse, is a researcher and data guy at 1KX, turning complex on-chain data into insights for founders and networks. His work focuses on crypto networks, token design, and market structure, helping teams design sustainable economies and understand their users. Before joining 1KX, he was at Open Block Labs where he worked on blockchain data and analytics infrastructure. Please join me in giving a warm welcome to Mr. Mouse. Mr. Mouse, sir, the floor is yours.
Okay, hello everyone. Can you just hear me fine? Well, welcome. Thank you so much for having me. Actually, really excited about presenting today. I see you had Ali from Anthropic on last week, so I think you're having quite a lineup. So yeah, so as I already introduced you, I'm basically a data guy at 1KX, which is a crypto VC or crypto native VC. So I get to do Onchain data for a living, which is a pretty cool thing. And as I understand today, I'm going to talk with you guys a bit about how to write an investment grade report, or basically how to write, or basically how to turn the on-chain research into something that could be useful for an investor lens. So I'm going to do that from a perspective that I'm having every day, which would be a more institutional grade one. It is still helpful, or like you can say apply the same framework if you, for example, are writing up something that you want to share on Twitter or like for reach. And I guess the same would apply also like for our investment side. Still, like disclaimer, you guys know, not doing investment advice today. But yeah. So actually, I did a small presentation for you guys. You should be able to see my screen now. Yeah, can you confirm that? Okay, great. So that's actually it's gonna be the thing today. So, so basically, what makes a report investment grade? There are basically 3 pillars to that. One is actionable, means like you need to have like a very clear thesis about sizing, positioning, risk framework, triggers, and if a reader thinks, okay, it's just interesting, it's kind of a failure. If the reader like says, oh, okay, that's actually something I might want to dig into more, that's something you want to have. Second pillar is verifiable. Every claim you need to make is or needs to be somewhat backed by a reproducible query for link. If you're using on-chain data, and that's actually also the crypto advantage where you're able to take advantage of public data. Otherwise, if you're taking off-chain data, you really need to be able to answer a big question like, oh, why do we think a certain thing? And then also timely, I think that's obvious one. Basically, a stale dashboard is like killing credibility. If you are setting up a dashboard or if you're setting up a investment thesis or write-up with data that's like a month old or 2 months old, that's not really helping your credibility in this case. Basically, what you always have to ask yourself when you're writing something like this up, if a decision maker could write up or could not act upon such a report alone, talking about the investment grade report, it's not really investment grade. Of course, it's a bit different if you're doing a bit in a leisure way, but still it's a good thing to hold yourself accountable to. So basically, how does it look now for the autonomy of such an investment grade report? Basically, every report more or less has rather like 6 sections. The most important one of them all is the executive summary. It's like basically the conclusion of the whole thing that stands in the start of the report. And basically, this is usually a thesis in 3 sentences, which would be like possible risks, the rating, the ask itself. And basically, if this doesn't hook, and if this is not interesting, the whole report is not interesting. So this is actually the most important thing to get right when you're typing up something like that. Same goes for anything on Twitter. So for example, if you are wanting to write about a protocol, a token, or some interesting stuff on chain, and you want to write a Twitter article, actually a very similar thing. And then, yeah, market context, basically, yeah. What's the sector? Is it sized up correctly? What's the competitive landscape if you're talking about a specific protocol? And yeah, then on-chain evidence itself. They spend most time. Basically, you want to separate crypto reports from track file memos, financial modeling. Yeah, revenue drivers, token economics depends heavily on your angle, on your thesis. Then risk metrics, similar thing, also very dependent on the protocol you're looking into or the angle you're having. And then recommendation, basically that's, yeah, basically your conclusion. Okay, and that's very interesting. So there's a difference between a venture memo and a liquid memo. Both have the very same structure, however, are completely different. And that's also something you need to really like drill into for yourself. So there's a difference between venture and liquid in the sense that, or like it's pretty unique to crypto where you have usually two vehicles, at least if you're a fund, to just buy tokens or you can just get some equity. And the same thing applies when you're writing a report. So venture, you have to think about, has a much longer time horizon in what you need to analyze. Like, will this be around in 5 years? Has a much stronger emphasis on founders themselves. And the liquid one is very quantitatively driven in comparison to a venture memo, which would be more qualitative in the measurement you're taking here. So in the liquid memo, which I think is also what you guys are thinking mostly about when you're thinking about an investment grade report, because that's basically all on-chain stats. So if you're analyzing like a token, you know, is it kind of mispriced? Is it an opportunity? Whale flows, exchanges, sex balances, other catalysts? Are there like relative variations to a peer group? You know, among the DEX, is there anyone that you may think is maybe mispriced or like according to certain things, maybe not the right fit? Many funds do both, and the best analysts usually also do both. However, it's very important to remember that you only apply one at the very same time because both are very different lenses. Okay. I'm going to throw you back, guys, into the structure on like how to get the executive summary right, because I think that actually may be the most important thing to get right. I've already stressed. So basically, it's a very short abstract. It's usually like 3-4 sentences that need to be good. So decision maker reads this first. If it doesn't hook in 30 seconds, not going to read the rest. And I'm going to walk you through like somewhat of a template here. So basically, you start with a thesis, usually one sentence with a specific metric you focused on, depending on like your framework, on your scope you're having in this report. Evidence, you back this up, which is like usually 2-3 numbers, which are kind of hard. The risk, which would be a certain or like possible pitfalls, which you could explain in one line. Giving the recommendation is not necessarily a thing, especially when you are writing this up just for yourself or something shareable on Twitter. But if you're writing this up in a venture context or like in a context where you're looking for someone that's looking to really make an investment based on this, usually it's a specific amount, variation, or certain triggers, kill conditions, make conditions, yeah, and the monitoring, basically, what would make you reevaluate the thing. So basically the key, the executive summary isn't really a summary of the report, it's the report itself in a mini form, yeah? So basically someone should be able to make a decision or like a preliminary decision based on this executive summary alone, which is kind of hard to get right, but after you you've written up, like, or if you write up a couple of them, it's pretty good. Also, another thing is, which is kind of important, is to not do this thing too complicated. So you always should ask yourself, if you will show this like to a TradFi person or like to a person that doesn't know the underlying I'm talking about or like doesn't understand probably like the basic economics of what you're covering here. If they don't get it with this executive summary, I need to rewrite it. Maybe you just maybe you should just send it like to your mom or like, I don't know, some friends to proofread or to cross-check and see how they take it and adjust accordingly. Yeah, going in that signal versus noise. One of the most important things to emphasize, because that's something I see a lot of people do wrong or get wrong. This is not really exhaustive, it's just some kind of patterns I'm seeing constantly. That is not necessarily related just to investment boards, but like analysis or like Onchain analysis in general. Yeah. So basically, if you would look, for example, just to growing users. Okay. First of all, or like you see this a lot on Dune, or like you see this a lot on Twitter, where people just take the amount of active addresses and say, oh, okay, the amount of active addresses like grew by this amount, but actually say, okay, the amount of users grew by that amount. So that has like a couple of pitfalls. Firstly, is that a user usually has multiple wallets, so a wallet is not equally a user, and the same thing goes for the usually Sybils, or like tons of Sybils, which is very important to, at least if you're looking into like in a sophisticated lens, to somewhat Sybil filter active users. And if you're really good, you also look into cohort retention, which is something which is usually a bit underlooked in or like understudied, and actually is much more valuable than just looking at the growing users, because if you can see if wallets or underlying users are sticky, it's a bit more valuable than looking at just, okay, that's like this amount of them around this week or this month. Same thing goes, yeah, it's basically also going to this point, like ignoring wash trading and Sybils. Depending on the chain you're looking at, actually, it's very interesting. There are more, or like a couple of chains of protocols that suffer more under that than a couple of others. If you, for example, you can't really compare transactions made on Ethereum to the amount of transactions made in Solana, just because the chain itself is structured totally different and just is making just tons more of transactions. So you really need to get this right, and you can't really compare the same, even though it's the same stat, to two different chains. So you really need to think yourself into these things very deeply. Yeah. Another thing probably to pick out is like TVL. Just like a raw TVL is easily or super easily inflated by incentive farming or something else. It's much better to, for example, look at organic TVL. Basically strip out rewards, see what's sticky. Yeah. But there are tons more, and you'll see tons of them more the more you go deep into your journey into on-chain data analysis. But yeah. So a bit like what I already mentioned, like in comparing two different chains, noise and signal are very different depending on the sector you're looking at in the crypto space. So basically, every sector has its own noise pattern. For example, DEXs like MOV bot volume. Usually, if you would just query, okay, I query like the DEX trades database on Dune, you would get everything inside, which also means like MOV bot activity or like other botting is inside that. If you want to create real signal insights, it's very important to swap that out or like adjust this query to also look at organic swap volume from like labeled retail institutions. So what you usually would do is like filter out certain address types, certain contract types. So that doesn't happen. And if you're really good, you also look at what kind of addresses are doing like the natural trading here, and you can label that, or like people is labeling that by the wallet history. So for example, retail would be like an assumption, okay, it's a guy that trades less than 5 times a day. Institutional would be maybe, or like a high frequency trader would be trading all 5 minutes or all 10 minutes, things like that. Same for lending, there's recursive borrowing loops that inflate TVL, utilization rate, there's real demand there. Also going for L2's transaction counts, or like Adobe Farmers transaction counts are noise. Gas spend per user is a bit more of a genuine intent. Basically, you need the domain expertise per sector to know what to filter. If you start off, right now your journey as an Onchain analyst or like as a crypto data guy, it's usually smart to focus on one area and then just build yourself out from there. I think that's also like most started off. Bit of common mistakes. Also not exhaustive, unfortunately, and you'll discover your own a lot. So for example, when you're anchoring on a narrative, it's usually smart to flip it around. So basically, you hear a story that's like saying, oh, okay, the volume of trading card gacha protocols is this amount, and I make this amount of money. You can try to find confirming data. What happen is you would find, oh, okay, the usually circulated amount of revenue for gacha protocols is like the revenue before certain buybacks are happening. So there's a different net revenue stat actually around. And that's actually something you could pick up, and that's something you could raise awareness for. Another thing, like to cherry pick timeframes. If it only works in a 7-day chart, that's not a thesis. Yeah. Usually you should have a bigger outlook. Best is usually all time to have the whole scope. There are a couple of exceptions for this, for like really high demand or like very successful protocols that are just starting off. I think like a good example was the early football fund, if anyone heard of that. Yeah, another thing is usually like something like no risk section. There's usually like none around. It's usually kind of important to have it, at least to raise awareness for certain pitfalls. Yeah, and like basically data without any backup, any chart. So kind of every chart needs to take away, or it's just decoration, there's no point of having something just because it's nice and like around. Just doesn't make a point. Also, if you think about it, there's usually, or like analysts, or like I think we guys, we usually tend to include 10 different charts. However, you always have to ask yourself, like, okay, do these 2 or 3 charts, or like aren't they actually like really condensable to one? That's usually also like a common mistake. Also not super exhaustive, but yeah. Yeah. Oh, sorry. Okay, yeah. Another like more common mistakes. Don't worry, guys. You're gonna get into the positive side soonish. They're a bit more subtle, equally dangerous, probably more dangerous, is conflating protocol revenue with total fees. So if you think about it, LP revenue goes to LPs, protocol revenue to token holders, is a very different story than just looking at total fees. Another thing, for example, is like trusting self-report metrics. If you can't check it on chain, you should definitely check it. So just because there's a very popular Dune dashboard that's maybe self-created by a protocol or by like another data person, it's usually smart at least to back check the underlying data, because it happens very often that this data is not very accurate. I think like a very popular example of that was some months ago. I think the poly market controversy, which was about that many Dune protocol or the many Dune dashboards actually had a misstating of the volume they're having on their protocol. Yeah, another thing is like something like assuming governance is centralized, you should check how many wallets actually are voting, or like just assume because there's X amount of wallets around that it's super decentralized doesn't necessarily need to be the case. You should always check, okay, check like set metrics like Gini coefficient. So if maybe the top 10 wallets hold like 80% of the supply, and same goes around like for simple detection. So for example, it could happen that there are like 2,000 wallets and 1,800 of them are connected. Actually, this used to be super common in like the meme craze, especially around how do you say, like famous or like VIP meme coins. Okay, let's go to next step, benchmarking. Interesting points. So basically, don't analyze in a vacuum. Don't. Like every metric is meaningless without a comparison you can compare it to. So a protocol that has 100K active users sounds great until you discover the one that's a sector leader with they have 2 million. So basically, there's like a couple of things you can like easily track. This list is also not exhaustive like most of the things here. If you look at TVL growth, it's super easily to compare, especially for the major protocols. Just go to DeFi Llama. Is the growth real? Is it just like a sector tailwind? Is this protocol just driven by probably farming or things like that? Same goes for active users. You should like lay it into the sector. So basically, what many people do is usually they compare the active users or like the user bases of a protocol to its peer group. So how you can imagine that is you would look at, for example, the Onchain history of certain of these wallets that are using this protocol, or whether they have a certain balance or things like that. And then based on that, you could make actually much smarter or more educated assumptions based on that, instead of just looking at active users or active wallets. I think I don't need to go like into all of them. Maybe to pick out one is retention. Very interesting is, or like this is something we do a lot, or like it's often done in the sector, is a certain protocol able to have more sticky wallets or more sticky users than another one? Are they just staying or are they passing through? That's something very interesting usually. So, okay, analytical lenses. So there are many scopes that you can approach to set up like a report or to set up an analysis. Maybe like to go through that. There's narrative, which is basically user, which is like the sector thesis that you're having. It's like team, macro tailwinds, timing. Is there like can there like a regulation out, and it's like something good or bad for lending protocols, for example. User growth, tokenomics, technical things, which is usually not really on chain. Competitive advantages. Is there like a macro thing that's happening regulatory? Is the revenue doing good or bad? So basically, I think maybe revenue is something that's like the deepest and hardest and closest to ground truth. So basically not saying, or like basically don't ignore the narrative and like don't let the narrative substitute for evidence. So basically, what I mean here is just because you came up with a certain thesis in your head, or like you already like kind of made up your mind. If the data doesn't back that up, it's also very valuable to actively reject the thesis in your report. So basically, what I mean, if this is like an analytic or like an investment grade report, doesn't necessarily always need to be a positive outcome for what you're currently looking at. Yeah. Basically, where most research stops and why it fails. There's a case to be made for actually going deeper. So usually there would be like a narrative, same protocol pitched, like 3 narratives for 12 months, data didn't change. Okay, that's not very good. Looking at user growth, like if it's 100% subsidy driven and then incentives and usually like 90% advantage, there are a lot of common examples for that. Looking at tokenomics, is it good? Is it bad? Does it actually have a fit, or is it value driven or by the underlying company? There are many actually very successful companies with very bad tokens around. If you would kind of analyze the token, or like if funds or people would have analyzed the token properly beforehand, they wouldn't have made certain mistakes. Same goes also the other direction. Then also like macro alone thesis. Like crypto winter narrative is like it's caused like many funds or like many people to pass on very good things. It's usually good to just ignore macro. If something's good, it's good, and it's good usually all the time. But yeah, so let me go a bit into the revenue lens. Revenue is like the closest thing to ground truth, usually. So basically what the caveat is here, revenue isn't perfect either. Some protocols are like pre-revenue, some are still valuable, like infra plays may not have direct fees. Other protocols potentially have like the potential to make revenue, like just didn't make a fee switch. And also revenue composition is actually a pretty big thing to look at for too. But for most protocols, revenue usually is the strongest signal. So there are a couple of metrics. Protocol revenue is like basically total fees paid by user. That's actually something these days that's very easily accessible via token terminal, DeFi Llama. In some cases on Novo, you gotta backcheck all 3 of them to some scope, or like cross-check them with each other. It's pretty easy usually. Revenue quality is it organic? Is it incentive driven? Is it sustainable, diversified? Is it maybe like off-chain revenue? For example, if you look at the most profitable businesses that are featured on sites like Token Terminal, DeFi Llama would be the stable firms, which make the biggest chunk of the revenue actually from off-chain fees, or like from off-chain income, which would be basically just a return on the big piles of money they have laying around. Looking at revenue per user is usually a very interesting metric, especially for consumer applications. Is it trending up? Does the protocol have like some more pricing power? Is going down, or like kind of leading to commoditization of this thing? Which is actually very interesting. This is something that happened to a lot of L1s, or at least active decision of them. Yeah, comparing revenue and incentives. Yeah, so making $1 in fees or in money for spending $3 in tokens is not a good unit economic. And yeah, take rate, like what actually stays, and revenue sustainability is something to look into too. Like a lot, if you, for example, look at a lot of these Solana protocols, they had a hard time in keeping up the revenue, although they're still performing much better than many of the ETH ones. Okay, so basically, let's dive a bit deeper into that. So if you look at total protocol fees, means like revenue up, incentives down, usually would indicate a good product market fit. If revenue is flat, incentives up, buying sideways, that's like usually something not sustainable. And then like the couple of like things you could like imagine. So revenue per user is going up is a good thing, speaks for the pricing power of the protocol. If revenue per user is going down consistently, it's heading towards commoditization. There are a couple of caveats and exceptions to that as well. If the protocols are going down these kind of routes by their own fruition for as a growth strategy. So you always need to kind of like ask yourself, okay, does this actually fit? And then, yeah, is take rate defensible or is like take rate very bad? Bottom line, these things aren't really subtle. They tell you exactly what's happening beneath the narrative. You just got to backcheck or like ask yourself, okay, this thing is like that. Maybe there's like a second data point that would explain that. Okay, going into that. Onchain data workflow, which is basically the process how you would ask yourself anything. Like also if you would for example, look at the revenue protocol. But yeah, this 5-step process is basically the process for everything. So you got to look for your source, you identify the addresses, contracts, governance, multi-sigs before opening, basically kind of anything. Then you extract your things, which is on account sides. It's GNSQL, can be DeFi API, can be token terminal, Hansen, Arkham, Allium, can be something custom. Usually depends like kind of heavily on what you want to analyze. Not all chains are like decoded everywhere, and you kind of need to be agnostic depending on what you want to analyze. And some of these tools are more institutional grade, some are more like user-centric. Usually, it is a good route to go for the protocols where you're able to code yourself. So yeah, then you clean your data. Most people skip that part. It's kind of the most important thing. So for example, if you're looking for active users, it's usually a good idea to at least exclude symbols, bots, MEV, if you're comparing different chain protocols to do some normalization. There are a couple of edge cases, but I think bottom line is like if you know it's garbage, it's good to throw it out. For analyzes the cohorts, concentration metrics, peer benchmarks, trend composition, highly depends on what you're actually looking at. But basically, you have to ask yourself, how can I condense this metric down to what it actually is? And then narrate, which is after all of this work you've done in these 4 steps, also kind of important just to translate and like explain to other people what you basically did here, and also to communicate your findings properly. Yeah, I'm not sure if anyone's interested in that. My tool stack, Onchain data platforms. There's tons of them. What I would usually use is like something like Dune, just for customer scale coding, Allium to a certain extent too. What I would highly recommend you guys to look at too is, is to be a bit agnostic in the way you're approaching things. So when you have a hard time deriving a certain metric from Dune, it's totally fine to also get that from another side. So it's very good to be agnostic. What I do, for example, do a lot is use all of them in combination. So for example, you would go to Nansen or to Arkham first and look at the wallet labeling or like entity level analysis and take the data from there, apply it on Dune and code around basically, which would be usually like your primary workbench in most cases for you, I think. And then you would go for high level data stats, usually like DeFi token terminal, Misari are good address. Just to have sector-wide coverage. Depends a bit on the sector you're analyzing. If it's something that's a bit broad, like DeFi, they're usually like super good. But yeah, and then there's like tons more like to analyze, to look at. For example, like Bublox is pretty good at the holder clustering or like initial symbol screening. block Scott is really great if you are building one in an stack, as they have like this cloud integration. So you technically can query block Scott via Claude, Dex Screener, same thing. And there's like tons more. And actually, what I want to emphasize here is, as we are like more going down more the route of integrating AI processes into our workbench, or like as people are doing that and the tool stack's getting bigger, this becomes more important to be a bit more agnostic on the things you're using, which makes it a bit more important to get the basics right. Okay. Okay, which brings me down to this. Don't build a fixed checklist, doesn't work. So basically what I mean, if that metrics depend on the angle you're exploring, what that means is like for growth, organic TVL, Sybil filtered, data active users, core retention acquisition source, things like that. When you're exploring revenue, for example, it would be protocol fees, revenue per user, take rate, incentive ratio, or for example, if you're looking at sustainability of the protocol, would be revenue without incentives. If the protocol did an airdrop, maybe post airdrop retention in general, retention, possibly developer churn rate. Again, like all these lists are not super extensive. You have to find like your own way of adding up a couple of sources there. But bottom line, I think this could be a good start. Okay. Okay, and you skipped that one. So basically, let's cut a bit to the bone. From raw data to investment thesis. Let's do it in a venture example. Usually, most people struggle in translating things. This is like kind of the hardest thing, basically communicating the things you find to like your audience in this case. So, for example, you have protocol X. You look at TVL and transaction data across 3 chains for over 90 days. What you would do then is like you would clean that, you strip the like incentive farming if there was any going on, or like sibling, if there was any going on, you normalize the cross-chain stuff, kick out bots, and based on that you would make the pattern analysis, which and put that into a context to competitors, and then you would see, okay, this protocol did very good in this context or not. User interpretation, so basically where you would determine, okay, is there genuinely product market fit or not? Are users staying without being paid to stay? Are they actually doing it like on an own fruition, or like are they doing for a financial incentive? And yeah, based on that, you do the risk check, which could be something like looking at holder concentration. Is the team locked up? Are there any unlocks going to come soon? And then based on that, you make a thesis. So you would recommend, okay, this could be something, or this could not be something, and add some triggers. Having said that, that's still very quantitative. What would usually come on top of that from a venture guy, or like maybe from your chin in this case, is like the quantitative things around the team, around the founder, or the narratives. Because it's like kind of important to still remember, because we're dealing with on-chain data. It's all historical data, so it's very hard to make future predictions based on that, especially if you're looking at something qualitative, like a venture case. Which makes it a bit easier to look at a liquid case. Still same hurdles applied though. Actually also has the same framework and different speed and output. So basically this means for you, if you're like data guy, or like if you're an on-chain data guy, that would mean that you would need to go much deeper into the token statistics. You would also look a bit on the protocol usage, etc. Is it doesn't make sense? Is it like feasible? But there's a much bigger emphasis, for example, on a token. But yeah, so I've been talking a lot on the Sybil analysis. So most Onchain users, I like 89% use noise. You guys might think, okay, that's a bit exaggerated. It's actually not really. If you're not filtering, the analysis is kind of fiction. So basically what this means for you is usually more or less like 5 methods to do it. No single method of that like really catches everything. You kind of really need to combine things like that, especially when you are using like especially when you're like on a free tier, you kind of need to make usage of multiple of them. And even like then if you do it, there are very smart people around these days. Usually it's more like of an 80-20 principle. But yeah, so there's things like funding source clustering. Basically, you would look at how wallets funded by the same entity. Are they funded by the same people? Is it maybe done in the same window? Behavior of fingerprints is how you would look at transaction patterns. So for example, are they receiving funds from a wallet at the very same time all the time, or are they transacting in a very similar manner? Same goes for gas pattern analysis, actually. And yeah, what's actually also pretty important, not too much if you look at active users, but more if you would analyze, for example, the holder base of a token, would be to introduce something called balance thresholds, basically saying to filter out dust wallets with minimal funds. That's actually an issue more on the very cheap chains or meme tokens. As you all know, like if you have a wallet, you're every now and then getting some small, like very random meme tokens sent. And that's usually that, and that's why it's important to filter it out. Because if you think about it, like a user that has, or like a token holder that has like less than 1 cent in USD, for example, in a token, shouldn't really be counted in the same manner like as one that would have 10 or like $100 holding. And yeah, also usually good to cross-reference your stuff like Nansen Arkham labels, things like that. So how do you read like the token distribution actually? What you would look at is the top 10 holders, top 20 holders, top 100 holders, basically like in this manner. And then you would have red flag, okay, top 5 wallets hold like 50% of the supply. What's important to look at there usually is sometimes happens, especially if you look at younger tokens, there's usually some contract there. It holds like at least on-chain the majority of the supply, but maybe it's like still a locked supply that's not going to unlock for a couple of months or like years. Maybe it's like some foundation that's related to the token or like to the project, things like that. So just because top 5 wallets hold 50% of the supply doesn't need to be an immediate red flag. You always have to see like everything a bit in moderation. Same goes for the Genie, where like above 80% is kind of concerning. So, but yeah. Same for unlocks. Usually it's not the smartest idea to buy into unlocks or like to as like usually have a very increased sell pattern around in this time. There are cases where it can make sense, but usually a bit more rare. So what does mean like red flag is like the tokens are unlocking, or for example, team tokens already unlocked the TG, which is not the case too often anymore, but still can happen. Red flags would be, for example, like governance dominated by sub-free entities, or like by one guy, like unknown wallets accumulating quietly. Can be also green flag in some parts, but anyway. Oh yeah, exchange inflow spiking without news, something like that. For those that don't know like how to read exchange inflows, usually it's assumed, especially for alts, that an inflow is likely a sell action. So a lot of them without news usually is like kind of, or like somewhat of a red flag. But yeah. Yeah, quote analysis. I think that's something already like kind of explained is like pretty underused, important to look at, especially if you want to justify something like active user counts, things like that. If you're thinking about like portfolio monitoring, so basically if you have like a D&D done, or like if you made like your investment report and you're like working in ABC, or like you're working in a fund, or like you made an investment, maybe also like on a personal level, is like D&D like doesn't end like when you write the check or like when you did the investment. It's usually smart to keep tracking at least of some key things, which should be like exchange flows, retentions, how they're changing, things like that. But yeah. What I want to emphasize a bit more is like on venture versus liquid, and how the Onchain data applies differently there. So basically, when you would look at venture, survival and dominance question is there like much more. You're looking at long-term metrics, growth rate, and like level limit. If you look at liquid, it's more of a mispricing question, near-term signals, and like current levels that matter much more. The trade fees is like with certain triggers. And that's like actually kind of important depending on what you're analyzing here. Are you analyzing the protocol, the firm, or analyzing the token? And very bad analysts usually apply only one of these frameworks, or they like they match them up. Best case usually you switch between both. Yeah, same thing going into the direction like combining on-chain, off-chain data. The best analysis, or like the best analysis, usually like kind of layer both, because neither alone can give you the full picture. What I mean with, or like I think you're very proficient in like knowing what on-chain tells you, kind of tells you everything that's around. That's like the application layer. Still, off-chain is very important. In the sense that it also includes like things like, okay, are there like any cool people around in the firm? Is there like any like thought leader attached to this project? How are developers acting on GitHub? Is there like any traction at all? Things like that. Yeah, cross-chain normalization, I think that's something, for sake of our time, I'm going to skip a bit. It's kind of quick, but kind of important. So for example, if you're looking at an ETH mainnet user that's doing $5 in gas, it's not really the same as, or like shows more conviction than cheap chain user. That's actually also something applying like to revenue and things like that. That's something you usually only encounter, like have to deal with once you're analyzing cross-chain things. So it's not appearing in too many cases. Yeah. Which brings me kind of like one of the key things is translating this stuff into non-technical decision makers, or would be basically your audience. So basically, instead of like a DAU and like you would have like a decay curve, it'd be user retention rate. Instead of talking about Gini coefficient, you could talk about ownership is really concentrated as a governance risk, or like free accrual, 15% week on week would mean like revenue is growing 15% week from real usage. You can use like Web2 analogies there, or like other easy examples. Basically, like the rule is like if you can't translate this, or like if you can't explain this in one sentence to a third person, or like someone who like doesn't know what's really going on here, you need to simplify stuff. That doesn't mean you need to dumb down, just means you translate. That's somewhat of a difference. So basically, key takeaways as we are like wrapping up. Investment grade means actionable, verifiable, and timely. You need to lead with a narrative. You need to lead with data and not a narrative. On-chain data doesn't lie. It can be misleading without cleaning. If you look at your workflow, you need to go into this very deep. You need to source, extract, clean, and analyze, and narrate. Please don't skip clean. If you look at things from the revenue lens, that's good. Revenue is one of the things that's coming up very much now as a metric, and in general, I think it's usually one of the things that's closest to the ground truth. If you're just coming up, build in public, make your things reproducible via queries or GitHub scripts, or like there's so many options on making it reproducible these days. That's your credibility. Please don't do anything bad based on that. And if you're around in the space for a longer time, you'll see like most VCs, most protocols. I see that a lot actually underway on-chain analysis. That's the opportunity in the future. So yeah, thank you so much. And are there any questions? Okay. So I think you're waiting for our host. Oh, okay. Cheers.
Thank you so much, sir, for that incredible session.
Yeah, thank you so much for having me. Yeah.
From our audience, and it says, yes, sir.
Oh,
Is there
I'm
a
so sorry.
cost for these services?
I'm sorry. I think you're cutting out with your audio a bit.
Sorry, I don't know.
Until properly.
Can you be more specific? What type of analysis are you referring to?
So is there a course
No,
for this
I'm
kind of
referring to
analysis?
the
Yeah. Oh, sorry.
yes. Yes, sir. Can you hear me?
Oh, I can hear you. I can hear you now. So yeah, is there a course for this type of analysis? Oh. I don't have a course. You can follow me on Twitter and like learn what I'm posting about. I think what would be maybe helpful for you guys, I think I'll type up a couple of articles where you can read about that. But yeah, I think what's usually the smartest way to do it is just to pick out a topic that's sticking out to you that you may find interesting, maybe something that's a bit understudied, and just start.
Okay, awesome. Thank you so much, sir, for that response. So, yeah, I have a few questions here of my own that I would like to ask you. So, the first question is age of artificial intelligence and the rest. So, like with AI tools improving rapidly, yeah, I know that okay, there are also existing research AI tools out there, but I don't know if it's like niche to like the on-chain space, but how should analysts generally adapt their research writing to remain relevant and valuable despite the whole rage of AI and the rest?
So basically, how on-chain analysts are going to adapt to that, yeah. Yeah. So basically, what you have to imagine is like with the emergence of these tools, it makes stuff much easier to do, and it allows us to become more efficient at our job of analyzing on-chain data. Like that can like really started like having an I write your SQL script. You can plug it into Dune and you can run it until you don't get an error message anymore, which is actually pretty good, very helpful, and speeds you up. What I do, like personally, is like we work a lot with AI tooling around ourselves, and we work a lot with plugins, and especially like with cloud skills. So what we're doing is we are optimizing especially repeatable research, especially something like tracking of certain metrics, which is something very helpful. It's something that's was not possible before. Also goes for like data aggregation. For example, it's much easier to call certain APIs or to web scrape with this kind of tooling. But I think that's really like a thing that deserves its own place or session. I think what's a good thing to start, and for like every one of you, or like for every like on-chain data analysis, is just to, I don't know, like go to Cloud Code or like any other AI tool and just ask it a couple of questions, like do some plugins. Don't download anything malicious, and just start off and start exploring, because I think actually this may be a niche that's still a bit understudied in our space right now. It will come though, and I think like if you meet again like in 3 months, we'll have like a totally different conversation about that, and stuff is like becoming really powerful really quickly. For example, you could totally create like a skill that allows you to automatically have written up certain investment reportings. The only thing where you would like just come in is like back checking the data, which makes it a bit more important to just do the basics. But yeah, I think sky's the limit there.
Okay, thank you so much, sir, for that response. So I have another question, and it goes like this: in terms of your personal writing, like this is like directed to you as a research writer. So like, what is your personal writing routine like? Basically, do you have like any ritual or habits that really helps you to like make or produce better research and research reports?
Mm, a couple actually. So I think I'm writing like 95% of my research like for internal research. So what happens, and actually I still think that's kind of universal. If you are like writing it for like a broader audience, if you want to have it shareable, is like firstly like always ask yourself, okay, is this understandable? Like, is it like, does it make sense to a normal person? Second thing is ask yourself if the things you're publishing are like really correct. Like you really have to like add a couple of sanity checks for you. Are you losing something on the way? Does this stuff actually make sense? Or like maybe back check with existing analysis or like existing stats. Also kind of would help you maybe identifying wrong stats that are publicly around. So that's very important. And I think like the third one is just to ask yourself when you're typing something up, if it actually has relevance. Like that doesn't mean that you like are talking yourself down and like the importance of the thing you do. Just means, for example, you don't need like a 10th analysis of daily active users on Uniswap. That's something that's not super relevant. On the other hand, if you would be like a deep dive on like something like very very timely or like very in demand and like understudied, like I don't know, like BZ, which would be just like a trading card gacha protocol, or like still a lot of things on Solana. That makes much more sense. But I think that's maybe a question to ask yourself before starting off. Like that's like for like yourself, like asking things for yourself. And like rituals is, I think usually it's a good idea to start off with just sorting your thoughts, maybe like somewhat of a brainstorm, and like the approach you're taking from an analytical standpoint. So basically what sources you want to look at. It's like also like still happens to me that I'm starting off coding something very complicated and you just find out, okay, actually it was available on like Token or Meslari or something like that. So it's also kind of important to be aware of the landscape around yourself. But yeah.
Okay, thank you so much, sir, for that. So another question I have for you is, how do you normally promote like your research once it's published? Like once you put it out there, maybe in publishing sites, maybe like Medium, Substack, and the rest. Like, how do you actually promote it? Basically, what's like your distribution strategy and platforms for getting it noticed?
Yeah. I mean, for me personally, usually it's crypto Twitter. um, that's like I think like still the main hub for the community. I know like there's some people that are experimenting on Instagram and TikTok. I did see like people with like a lot of crazy reach there, but I think those are two angles that actually could be explored more, or like YouTube and like the other social media forms. I think there's like still a lot of growth probably to be there, especially when you're having like something very interesting. Maybe also LinkedIn if you after that. But yeah, and then based on like promoting around it, it's just you post it out. You post it out, and if it's very insightful, if it like has value, people usually catch up to it. What a lot of people do is like send it around to a couple of people that may be interested in that, and like just for awareness reasons, which also works sometimes pretty good.
Awesome. Thank you so much, sir, for that. So my last question is, say for instance you were a hiring manager, right? Or you were basically just hiring a researcher or maybe an assistant to like basically assist you in terms of research writing and the rest today. What would you like really look at in their writing samples to like really make a decision on that employment status?
Okay, that's a very good question. Because it's like something that like comes across like all the time. Like it's sometimes like getting applications or like some or like when I'm talking to other people that are hiring at the moment. It's what is usually very good or like very important when you are applying out to like any data analysis or like any on-chain data related position, which it's just not necessarily is just a data analyst, could be also like a normal analyst, for example, in the VC sense, but also could be any business function in a normal protocol. I think if you have like on-chain knowledge, you're like very, or like if you know how to analyze on-chain stats, things like that, you might be a fit like in a lot of departments in the space, also could be marketing. So depending on that, I think what is very important or like good to have is really to showcase that you understand what you're talking about. So for example, it's usually not just enough to have like to be like a data analyst. So what happens a lot, or like what I saw happening in a couple of protocols usually, is that it's harder to teach like a Web2 data analyst, crypto data analysis, because it's super messy, than to just tell like, or like to just teach like a very native crypto person the necessary data skills. So like basically what this means for you is ideally have like some very cool projects that you did in the past. If you can build like a good public image that can be like a good Dune account with like very interesting stats, there can be a Twitter account, for example, talking about analysis you did or like discussing like also other people's analysis or like maybe adding a couple of angles there and like build up a bit of a like small community. I'm not saying you need to be like a Twitter account of like 10K followers and myself not that big, but like if you maybe like have a couple of hundred, would be good. And then just like when you're applying out, just really know what you're talking about and like know the space and like its intricacies. That's like if you would be like applying for like a normal crypto firm. It's a bit of a different story if you are looking at the other project, the other protocols or like other startups that are coming up in the RWA style, which are a bit more traditionally run. But I would still think these things are run pretty similar to there. But yeah.
Awesome. Thank you so much, sir. So, thank you, Mr. Mouse. Basically, your session was very phenomenal, and thank you to our audience. Right. So, just a few announcements before we wrap up. Our code slash data teardown is coming up next week, Friday, March 13th at 8 p.m. So, and we are going to be featuring an SQL project. So, do well to tune in live. Then we would be having our community call, our monthly community call on Saturday by 6 p.m. So it's a chance for us to like come to connect, share updates, and hear from standard community members as well. So both events are free, of course. It's our community events and it's open to everyone. And the links will be shared across our platforms. So yeah. And we have in front of us our organizations. We have Sages Lab. Sages Lab is our primary organization, which is a blockchain research and development hub building on-chain data-driven solutions, where we have Analytic Sages, which is us under Sages Lab. Then we have IntelliSages. Now, for some of you, if you've noticed, IntelliSages is a blockchain data intelligence organization, right? And also a consulting and advisory firm that seeks to accelerate Web3 adoption across Africa. Then we have Fluxo. Fluxo is our private intelligence agent, which provides autonomous private intelligence that understands the market and executes high value strategy without information leakages for the DeFi protocol. So, guys, thank you so much for tuning in, and that's a wrap for this evening. So, this was brought to you by Analytics Sages, where intelligence is greater than hype. Thank you guys so much.